Hi, Adam Spears here again with Cross Country Mortgage. This week I wanted to address rates, how we get to a rate, discount points, which I've been getting a lot of questions on, and then on the other side of that, lender credit. So this came up today because I was speaking with a potential client and they were asking what a rate was on, say, a 30-year fixed and a 20-year fixed and a 15-year fixed for a refinance. So I went through and we had to discuss about rate and what the specifics were and how to get to his rate. And he had said, well, your rates are much higher than somebody else. And so typically when I hear that, it means that somebody's probably charging them discount points, which means you're basically paying extra money or rolling that money into your loan amount. So you're increasing your loan amount in order to buy down the interest rate, which is possible. We do it all the time. But I want to talk about what that looks like. So typically, when somebody's paying discount points, it's not 1 point or 2 points or flat. Typically, it's 0.78 points or whatever it is. And what that equates to for simple math is, let's say you had a $300,000 loan, you were charging 1 point to say buy the interest rate down. So let's say you're an interest rate flat that we weren't charging and you weren't getting a lender discount was a 3%, and to buy it down to say a 2.625% was going to cost you 1 point. So 1 point of $300,000 is $3,000. That's how much it would cost you to buy that interest rate down. Now, I'm just throwing out kind of wild figures here. They don't really equate or line up, but that's basically what it means. So typically when I hear that someone has a much lower rate than maybe what we offer, there's going to be discount points involved. Now, me personally, when I'm working with a client, what I like to do is give them a couple different options. I give them what the par rate is, which is the even rate, that there's no credit and there's no discount points. And then I talk to them about what it would be for discount points and then what their return on investment is. So if you're paying $3,000 to buy your rate down, I need to know how long you're going to be in this loan. Are you going to refinance it? Are you going to see a return on that investment because the interest rate is lower, therefore you're paying less interest, therefore your monthly payment is different. So I always calculate what the return on investment is, and I won't even approach the discount point conversation unless I know they're going to get a return on their investment for as long as they're in the house. So that's discount points. And again, it does get pretty confusing, but we can have a longer conversation about that, assuming you want more information. Now, the other side of that, when we think of it as a teeter-totter, is going to be a lender credit. So let's say you're having trouble with closing costs or you don't have a lot of funds. If we offer a higher rate, I have to give you back money. That's a lender credit. So conversely, if I were to give you a point back on a loan in order to help you pay for closing costs, you would take a higher interest rate, but then you would get a $3,000 credit on that same point for a lender credit. So that one's a little bit easier to understand, obviously. But discount points do make sense. I mean, I can't tell you that I haven't used them frequently with most of my clients. Again, typically in refinances, a lot of purchases people will buy down if this is going to be your forever home, if you're going to be there 5 or 10 years, and it absolutely makes sense. So moving forward, if you have any questions about whether or not discount points, or you should use discount points, or what the return on investment is if you wanted to buy down your interest rate, please give me a call or email me here. We can have a larger conversation because it does make a lot of sense. And as always, thank you, and we'll see you next week.